Consider the case of Nvidia, which is doing amazing things with generative artificial intelligence, generative AI, and accelerated computing. Those are the two biggest trends of our day. Those are basically their own cycles with their own rules, and they have nothing to do with the Fed. That's something we love them for. Not anymore. That's how Nvidia stock has become a wasteland. I mean, it's this interstitial gunfire. I mean, every day. I mean, thank heavens that the market stops. Thank heavens they ring a bell. Because then it can stop going down. Okay, sure, it's still up 110% for the year, but it's now down more than 35 points from its high, 140 to 104. I don't see it stopping here. That's not because Nvidia's business has deteriorated. Its products are selling amazingly well. Its competitor AMD on tomorrow and Squawk of the Street saying good things. It's because Nvidia doesn't benefit from rate cuts, so its stock gets kicked to the curb in this environment. The money you get back from selling the company's shares that are being redeployed are to the rate cut beneficiaries. No insult to Nvidia. It's about the stock, not the company. So why not get rid of the stock? Because Nvidia stock is getting cheaper as it goes down. Right now, the street expects them to earn $3.59 per share next year. But if this is anything like the Nvidia we've seen in the last decade, those estimates are probably way too low. Maybe so low that the company could eventually earn $4.59 per share next year. In that case, you've got a stock that conceivably selling at less than 23 times next year's earnings. I am not selling the greatest growth stock of our generation at 23 times earnings. I'd rather risk taking some pain. And maybe then, keep in mind, Nvidia is the premier growth stock of our time. I'm going to say it again. It's not going down just because skeptics feel there's no good return on investment AI. It's going down because Wall Street's become a lot less willing to pay up for the earnings of growth stocks. It's called multiple contraction. Right now, investors would rather chase cheaper stocks of companies that will get a massive earnings boost from lower interest rates. Think Stanley Black & Decker. Wall Street at certain junctures falls out of love with great growth stocks, abandoning them for cyclical stocks that will do much better in an accelerating economy. The year-over-year comparisons are just much better with these rate cut beneficiaries than they will be with the Mag 7. The market runs on these companies. But at some point, a stock like Nvidia gets so cheap, so darn cheap, on an earnings basis, can you believe it, that the selling will stop? We just haven't reached that level yet. I don't mean to be picking on Nvidia. Microsoft, Meta, Amazon, Apple have all been experiencing multiple contraction. Meanwhile, stocks like Stanley Black & Decker or the banks are experiencing multiple expansion.
One of the stock market's most attention-grabbing stories to hit the headlines in recent weeks is the sudden and swift decline in Nvidia. The previously high-flying AI chip giant has been experiencing a significant drop in its share prices, leaving many investors puzzled and even spooked. However, the story is far more intricate than a simple share price plummet. Nvidia, a company that has seen its stock more than double year-to-date, has encountered a sector rotation. Investors are moving away from large tech companies and towards previously lagging small-cap stocks, a shift prompted by the anticipation of the first interest rate cuts since 2020. But that's not the only magic trick at play here. The scenario is further complicated by insider trading activities involving Nvidia's CEO, Jensen Huang, adding another layer of intrigue to the unfolding saga. So what's the fuss? And what do renowned analysts like Jim Cramer have to say about this? Let's break all of this down. But first, if you want to keep up with Nvidia's latest updates and keep up with the stock market's latest news, you can follow our Twitter account. We post multiple times daily about the biggest changes and catalysts in the market, so click the follow button if you don't want to miss the newest market updates. Now, back to today's video.
Glorious. Now, we hear that many smaller cap stocks are winning here. It's a big tax donate share to them. Donation is a very tricky word, though. What's really happening is that big institutions aren't doing anything different than they usually do. They always sell the stocks that don't need the Fed to make the estimates and buy the stocks that will put up huge year-over-year earnings growth with the help of rate cuts. Of course, there are stocks that are basically bits and bobs. Procter & Gamble and Merck missed the numbers today. I can tell you if it weren't for China, those stocks would have actually gone higher. I'll go over China losers later in the show. Eli Lilly keeps going down because it's been up a lot. It suddenly has GLP-1 competition. But it's also suffering from the same multiple contraction as the Magnificent Seven. We don't know when that will stop either. A quality company, real bad stock. It's so easy to just dump all the great growth stocks that have done so well when you have cycles based on cell phone refresh or PC refresh or AI or accelerated computing. You sell them and you will feel so instantly relieved. You'll be like, oh, a steamer trunk removed from my back. Never forget, though, that you're selling winners, actual bona fide winners for stocks that were losers just 2 weeks ago. Selling winners for losers is indeed a longer term a mug's game, unless you think this rotation has immense multi-year staying power or you're a hedge fund with the ability to flit in and out all day and all night.
Given Nvidia's stature as a leading AI chip and software maker, It's no surprise that every bit of news about the company sends ripples through the stock market. Over the past few weeks, Nvidia's shares have tumbled significantly. On Tuesday alone, the shares dipped more than 8% before paring some losses, now sitting more than 25% off their recent June highs. This is the kind of roller coaster ride that makes even the most seasoned investors clutch their seats a little tighter. Many would argue that the sector rotation is the primary driver behind Nvidia's slide. It makes sense. Investors are taking their money out of large, perhaps overvalued tech companies and are reallocating it to small-cap stocks that have underperformed. This rotation is particularly prevalent as investors prepare for the Federal Reserve's first interest rate cuts in 3 years. However, there are other factors compounding Nvidia's woes. Let's not forget that Jensen Huang, CEO of Nvidia, has been selling shares, more than 3 million of them, since mid-June at an average price of around 126 per share. Insider selling can be like shouting, "Fire!" in a crowded theater. It makes everyone run for the exits. To some, Huang's sales are a harbinger of doom, signaling that it might be time to de-risk and sell off some of their Nvidia positions. But hold your horses before you join the panic party. Huang's share sales were pre-arranged through Rule 10b-5-1, a plan that allows company insiders to sell a predetermined amount of stock at set intervals. While this is a perfectly legal and above-board way to avoid the appearance of insider trading, it hasn't stopped investors from clutching their pearls and heading for the hills. Now, you might think, is this really the right time to panic? Let's find out what the accomplished investor and analyst Jim Cramer has to say about this. Hello everyone, and welcome back to Investocracy.
Catch with Nvidia too, though, is it's got a lot of resistance on the chart coming up. That's why we're still a good ways away from having the green light on stocks, because Nvidia's got to really fight to reclaim 120. That's going to be a tough level to get through. So that's another reason that there are still limitations here. But if you get the earnings to go as well as they have been so far, generally, Powell today was well received. If employment is surprisingly strong on Friday, that would be the hat trick for bulls to make us feel that we've really got the soft landing and we can have that high correlation rally instead of a high correlation sell-off, but I'm not quite convinced just yet.
Recently on his show, renowned economist Jim Cramer offered advice to his followers and viewers regarding Nvidia. Cramer acknowledged the recent drop in Nvidia's stock price, but emphasized that this decline is not due to any deterioration in Nvidia's business. On the contrary, Nvidia's sales performance is outstanding. Cramer, too, has attributed the dip to interest rate cuts, from which Nvidia does not benefit. He explained that investors are selling Nvidia shares and reallocating their funds to stocks that benefit from rate cuts, noting that the current situation is about stock performance rather than the company's fundamentals. When asked why investors should hold on to Nvidia stock despite the decline, Cramer argued that the stock is becoming cheaper as it falls in price. At the time of his commentary, Wall Street analysts projected Nvidia to earn $3.59 per share next year. Cramer suggested that if Nvidia continues to perform as it has over the past decade, these estimates are probably way too low. He even speculated that the company could earn $4.59 per share next year. In such a scenario, the stock would be trading at less than 23 times next year's earnings, which Cramer finds unacceptable. He declared that he would never sell the greatest stock of our generation at such a low multiple. Cramer reiterated his advice to investors, emphasizing that Nvidia is the premier growth stock of our time. He stressed that the stock's decline is not due to performance issues or a lack of interest in AI investment, but rather because Wall Street is unwilling to pay for the earnings of growth stocks. This phenomenon, known as multiple contraction, occurs when investors prefer to invest in cheaper stocks of companies poised to see significant earnings boosts from lower interest rates. On top of this, Nvidia is yet to announce its fiscal second quarter results, which are due on August 28th. This cloud of uncertainty might be driving investors to preemptively sell their shares. However, there's a broader context that needs assessing. AI sector earnings reports are due this week from notable companies like Microsoft and Advanced Micro Devices. What these corporations say about AI investments and chip demand will likely have huge implications for Nvidia's stock. For now, Nvidia remains the golden child of AI technology, even if it has recently put on a dunce cap in the stock market. There are signs of volatility everywhere, and some investors are not willing to ride that wave. They prefer calmer, smaller waters, hence the current migration towards small-cap stocks. It's akin to an investor being at a blackjack table who's on a hot streak, but then decides to take their chips to the penny slots instead. It's less glamorous, but sometimes a slow and steady gain can be more reassuring than the ups and downs of a high-stakes game. Adding to the drama, industry analysts are closely watching Nvidia's next earnings call, particularly to see how the company responds to any softening in AI-related demand. The stock prices of Nvidia's peers, Microsoft and Advanced Micro Devices, post-earnings, will provide vital clues. If these companies report strong AI demand, it could bode well for Nvidia. Conversely, any signs of weakening demand could further drop Nvidia's stock like a hot potato. According to Barron's, the AI chip market is still in its nascent stages, and Nvidia remains at the forefront. While this market is expected to skyrocket, becoming a trillion-dollar industry sooner rather than later, there's no denying the inherent risks involved in the present-day volatility. The recent insider sales and sector rotations merely add a spicy layer of suspense to an already simmering pot. So, should you invest in Nvidia despite the recent turmoil? The answer is far from straightforward. So let's break it down. But first, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
Nvidia shares moving higher this morning. One of the chip stocks getting a boost off the back of AMD's upbeat earnings report. But what's really driving this narrative surrounding Nvidia this morning is the call that we're getting out from Morgan Stanley. Morgan Stanley once again naming Nvidia a top pick here, a top U.S. chip stock here pick for Morgan Stanley. The first time that it has named Nvidia that in 6 months. And this move follows the recent sell-off that we have seen in Nvidia stock. You can see that towards the right-hand side of your screen. And Morgan Stanley essentially making the argument that the stock has, quote, sold off on a large list of concerns that we think are likely to fade with time. They went on to talk about AI capex levels remaining positive. Nvidia is still at the center of the sector, even as competition ramps up. So they're saying that there's a lot to like in Nvidia stock right now. You're still looking at year-to-date gains of just over 100%, one-year gains of 121%, but we are well below the all-time high that we did hit for Nvidia's stock, with trading right above $100 a share following that stock split. So again, Morgan Stanley at least making the argument, Brad, that there's still a lot to like within this name, and that it's actually set to move to the upside following that correction. Yeah, or move lower. Sorry, not correction.
Well, exactly, and I mean concerns that they expect to fade over time, which really lead them to make this call here. Some concerns: customer capital spending budgets and customer ROI, seeing consistent upside to AI capital expenditures everywhere, but customer comments about quarter-over-quarter progression of spending having an impact on AI semiconductor stocks. So all this really contributing to one of the core points that they make, in addition to competitive dynamics, export control, supply chain concerns. So, even as they're citing these concerns, they're essentially still coming back to the thought process of, despite all of this, they're still best positioned. And we've heard this from some of their other industry cohorts or some of their other industry constituents that are looking at this name. And even as we had heard Goldman Sachs call this a de facto AI play, Morgan Stanley is firmly back in the position of saying, all right, this is our top pick right now. And we'll see exactly where Nvidia continues to move off of yet another bullish rating coming forward from Wall Street.
Current market conditions have indeed rattled Nvidia's stock, but the company's fundamental strengths and positioning in the burgeoning AI market remains solid. It's a stock that could still offer immense growth potential for forward-looking investors. As of now, Nvidia's stock sits in a precarious position, balancing investor apprehension with the company's undeniable influence in the AI sector. However, the forecasts are optimistic, albeit cautiously so. Many analysts predict a rebound fueled by strong earnings in the coming quarters, particularly if AI demand remains robust. It's essential to recognize that stock market investments are not sprints. They're more like marathons with hurdles. Nvidia may be encountering a few bumps and hurdles right now, but the company's trajectory points to eventual recovery and potential blooming in the AI space. Investing in Nvidia now could be viewed as getting in at a discount, positioning oneself for the future gains when the market stabilizes. But with all investments, it's vital to weigh the risks and potential returns carefully. But what about you? What do you think about Nvidia's current predicament? Are you bullish or bearish on the stock? Feel free to share your thoughts. We'd love to hear your take on this ongoing market drama. If you would like to know what companies like Nvidia have been up to these past few days, go ahead and click on the next video on your screen. See you there.